Well, Nimesh Shah of ICICI Prudential AMC joins us. Now, Nimesh, we spoke on Friday, and between Friday and Monday, curiosity, panic, and redemptions have only increased. So let's talk about your schemes, ICICI Prudential Credit Risk Fund. Walk us through the portfolio of this fund. At a time when there is a lockdown, liquidity is drying up, a lot of companies are struggling with cash flow. Why do you remain confident that there is no liquidity stroke, solvency risk to this fund?
See, there are two parts in any of the funds. I think the basic thing that we should look at is the safety, that is the quality of the fund, and the liquidity in the fund. These are the two things that one has to look at. So if I look at the quality of the fund, last 23 years, we have not had a single case of any corporate where we have given money is delaying this fund. That is true in the last 23 years. It is true in the last 18 months also, where there have been a lot of downgrades. There has not been a single case with ICICI that we had a downgrade issue. Now, why was that? We have had followed processes which have been steady over the years. There has been a separate risk department which is way outside of the investment department. 5 of us have to sign off before we give any proposal. So that all kinds of checks and balances have been kept in creating a portfolio. So when I'm looking at the portfolio today, we had a review, we have continuous review. I believe that the quality of portfolio is intact. COVID or no COVID, the quality of the portfolio is good. By quality of the portfolio, I mean a very simple thing that if I have given money to corporates, I expect that despite COVID or no COVID, the quality remains that the money will come back. In rating terms, if I say credit risk fund by the name, see out of 1,80,000 crore funds that we manage, 98% of that is above AA minus and above. 98% of that. Only 2% is below AA minus. In credit risk fund, 70% of the assets, right? 70% of the assets are AA minus and above. So that's the kind of scenario that we have built over the years, and that discipline is always kept. So the quality in the portfolio is there, right? Now I come down to the second very important part of it, liquidity. I believe that we have kept sufficient liquidity in the fund to take care of any kind of nervousness that can come into the market. I can sense in the weekend that there were people who were nervous. We have been talking to all our distributors. We have talked to a lot of investors. We believe that even if somebody gets nervous, we have provided for the liquidity, and that's where we are today.
Okay. Now, Nimesh, just a press release has come where RBI has just issued, and I'm just reading off the press release. It has hit my mailbox. Let me just download as we speak right now. RBI has come up with a 50,000 crore liquidity support for mutual funds. Is this good enough? I mean, this is a clear statement from RBI, Nimesh, that they are standing for the mutual fund industry. So this should really, douse a lot of nervousness which had come in. I mean, this is a clear indication that RBI has opened a credit line.
So if you remember 2008 and 2013, both the times the sheer comfort that RBI, so that's what before I talk about liquidity, your statement talks about liquidity. The total credit risk fund industry is less than 50,000 crores, right? The total credit risk industry is less than 50,000 crores. It should be around some 45,000 crores. That's what is the figure. So now if there is liquidity available against those bonds, I don't know what is the declaration that RBI has given. After your show, I'll look at it. But I'm very happy that government has stepped up so that the confidence in the investors will increase. How much ever I say, how much ever I come on the TV and tell about that, once people know there is liquidity behind it, the only thing they need to see is the quality of the portfolio. Because if quality is there, I'll get liquidity against that. That's what is that. If my portfolio is not of the right quality, then I will not get liquidity whatever I do. So that's a very, very important thing that RBI has announced. And I think this will give confidence to a lot of investors. So maybe if you can want to focus on that statement, I don't know that statement. You can focus on that statement so that your viewers can appreciate that statement. That is more important than what I have to say.
No, exactly. I mean, I'm just saying that I'm getting the press release right now. Pardon me, this network issues today for some strange reason. Or what we have right now is RBI has announced a 50,000 crore special liquidity facility for mutual funds. So, Nimesh, it's like saying that, look, RBI is saying that, look, we are there. 50,000 crore of liquidity is there. Whether mutual funds use it or not, that's separate. But at least this is an indication that mutual funds, if they have redemption pressures, there is going to be no desperate selling. Is that the way of looking at it, Nimesh?
See, the way once this is announced, in 2013 they had asked us that in 2008 this line was issued, but you never utilized it. The whole thing is that once this line is issued, there is confidence in the market and the line may not be utilized. That's the game. Last time also in 2013, the line was announced, we never had to use it. Right? When suddenly interest rates had gone up 2% points and the confidence in the market had eroded, liquid funds had given negative return, immediately the line was set up. As soon as the line is set up, the people have comfort that if there is liquidity required, and it's a sufficient amount, it's quite a big amount, that 50,000 crores RBI said that kind of line is available. I'm very happy to hear that. I think this will give a lot of confidence to our investors. That if any mutual fund requires liquidity will be available. And see, another thing about mutual funds is we have got more than 5 million customers. Right. So in this particular kind of schemes also, these are not corporate. This credit rate scheme are not corporate scheme or institutional scheme. They are retail scheme. In this particular fund of ours, there are more than 75,000 investors. So concentration is not only important on the asset side, right? If we have got a 10,000 crore fund, it has got 8,000 or 80 different kind of investments in that. 80 different kinds of investment in one single fund. Right, so that is the lack of concentration on the asset side. Also, your investors have to remember that on the liability side, it's very important. People don't understand the granularity of liabilities and the importance of it. So we don't have any distributor who has got more than 5% concentration in the fund. We don't have any geographical concentration. We don't have any investor concentration because it is all individuals. Right? More or less it is individuals. So there is only one concentration. That concentration is by ICICI Prudential. We as our AMC have put 340 crores of our net worth, which is almost 30% of our net worth, into this particular fund. Right? So that is the confidence that we have in this fund, that the AMC has put its own money in that fund. And if you would have seen, we had discussed it earlier, on 31st January declaration, if you see, that has to be given by every fund, that what has the management invested in this. The executives of this company have invested 42 crores in this particular fund. So I'm saying not only have we put our company's money into it, the management and the executives of this company have put their own money also into it. So that is the confidence we have on it, and I want your investors also to have that confidence that we have got a track record of so long that there has not been a single case where there is a default. Last 1 year, 1.5 years also, when so many companies went into default, ICICI Prudential didn't have a single case of default. So we believe that quality can continue, and we will be and if there is a case now, RBI has also come with a line. So 45,000 crore industry, and RBI has come with a line of 50,000 crores. Very happy to hear.
It's a relief, and I want to make this point once again for the benefit of our viewers. The challenge for mutual funds could have been, if redemptions would have increased, is liquidity. Now in this case, it's the Reserve Bank which is saying that, look, there is a line of liquidity which is available in case there are redemption pressures, and these proactive steps have been taken in order to calm the nervousness down. So first. Second, the point which we are also trying to bring out in our conversations with the different CEOs of different funds is that just like one shoe does not fit all, every credit risk fund does not have the same kind of an exposure. Do not look at previous performance as the guarantee. Sometimes in the comparative market, fund managers, rightly or wrongly, they end up taking a lot of credit risk because it's a comparative market. Some of this risk in economic problem like this, they tend to backfire. I'm not saying a fund is right or fund is wrong, each one to their own judgment, but this needs to be really understood by a lot of investors when they're investing in credit funds. So Nimesh, I want to take back that point once again, where in case somebody's missed it, that you are saying that the employees of ICICI Prudential AMC have personally invested about 42 crores in the credit risk fund.
Correct. This is in our 31st January. It is part of our scheme information document where SEBI insists that the executives, what they have put in their own fund should be stated over there. So this has been part of our declaration since 31st January. So I stand by that not only have we as executives invested, even our company ICICI Prudential AMC, the surpluses that we have been invested in this particular.
So this is like saying that the employees of ICICI Prudential AMC have their skin in the game.
So there is no reason that anything has changed. If at all the redemptions pressure with RBI, the redemptions, if the people will get confidence that there might have been issues in some of in one of the funds where there were some issues, but the more or less we'll be able to, at ICICI Prudential, we are reasonably confident that we'll be able to manage the situation. And with this RBI line coming, it is very heartening to know that the regulators have acted at the right time.
Okay, now Nimesh, the challenge with the credit risk fund is, like you said, that look, you got good quality paper and there is liquidity. So risk and quality, you've spoken about it. But who would have thought 3 years ago there would be a problem with Vodafone or a problem with Z? Those problems have happened, and that's largely because of the shape of the economy changed, the regulatory environment around us changed, and this 2019 slowdown forced a lot of corporates to open skeletons which they were hiding in the cupboard. So what looks good today may not look good tomorrow in this economic lockdown. What are the safeguards in place to ensure that if economic conditions worsen, your credit fund is protected?
See, I would give two difficult examples that we had, because a lot of media attention had gone into, say 3 years back, there was a case of JSPL, right? A lot of discussion had happened in media that JSPL, whether, and this is now history, so I can discuss that. 3 years back, there was a case when steel industry goes into challenges, right? The steel industry had gone into challenges, coal was not available. There are various problems at that point of time. So media kept on harping on that there is 46,000 crores of liabilities. But against those set of liabilities, there were 1 lakh crores of steel, world-class steel assets also available. So when there is a temporary problem, right, you need to, we were able to find a solution. We had a 500 crore exposure to JSPL, and every money came, all the monies of that particular company came back on time, right? We had to manage the situation at that point of time. We had to communicate. We came to your channel also to communicate our position. You said about Z. When the incident happened in Z, right? But everybody, a lot of mutual funds had sufficient security so that they could go out at that point of time. If in Z, we all would have gone to the market to sell the security on that day itself, then we would have never been able to realize that money. So my point is, if there is a problem, you need to sit across the table. The various creditors have to sit across the table. The bondholders have to sit across the table and find a viable solution which is commercially correct, right? So in Z, I'm very proud to handle the way we handle Z, that of course it was an issue, but if your security is enough, we had done Z, but it was against the shares of Z Entertainment. It was not against anything else. The only security that ICICI Prudential had was a sufficient cover on Z Entertainment shares. So even if the Z shares would have been sold at the break-even price had come to some 210 or something like that. I don't remember exactly, 212 or 213, something like that. That even if I would have sold at that price, I would have been able to recover my 100% money. But if I would have gone in the market on the first day itself, then I would not have done a good job for my investors. We waited out almost 6 months. We worked with the company, and over a period of time, every single rupee along with interest was recovered from that particular exposure. So when there is an issue, when you have given money out in the markets, there can be issues. But if your inherent credit is good, say today there is an issue with NBFC, a lot of discussion is there today that NBFC exposure. Since last 1.5 years, we have been discussing exposure to NBFC. But if you have given to an NBFC, which is promoted by a big corporate house or a respected bank, right? Even if there are temporary issues, those issues will be managed because quality of the sponsor is very superior, right? So the business has to be good. The quality of the sponsor has to be good. If you have done your due diligence on all these issues, then when there is a problem, you can sort out those issues. I'm not saying no problems will ever happen in life, but if there is a problem, you should be able to resolve the issues at that point of time. In 2-3 cases in the last 3 years, we have managed. That's all I want to say. That if there is an issue, there should be a management capability to resolve those issues also.
Okay. Let's try and understand, address a non-sophisticated investor here. The general definition of a non-sophisticated investor is that do your asset allocation have a mix of debt, equity, gold and real estate. Within that, put money in debt where you want low returns but you want safety. Put money in equity where you can accept volatility and you have to have 5 to 6 year time frame. Now the average Joe who's investing in debt mutual fund is advising because the distributor is indicating, or he's read something and has done his own research. How does the average investor in debt mutual fund who's bought debt mutual fund looking at YTM returns and the promise of past yield which could be superior in a scheme really understand the risk and the quality of the paper that scheme or that mutual fund is running? I'm asking this simple question, but perhaps these simple questions, Nimesh, today need to be addressed.
So for an average person, will he see a track record while past performance is no indicator of future? Will you see that this particular AMC, XYZ AMC, has not had a delay in last so many years? As Warren Buffett said, when the tide is low, then you will know that who's swimming naked. It happened in equity also some time back. It is happening in debt since last 1.5 years. Since last 1.5 years, we are able to understand that who's swimming naked and who's not swimming naked. The average Joe will see that they have not had any defaults even in a difficult period. The debt, I think this is the most important thing. Please, I would urge every person, SEBI has ensured that we have got a very good mechanism, right? SEBI has ensured that we have got a very good mechanism of, Nikunj, am I audible? Nikunj, am I audible?
Yes, please.
Yeah, sorry. So I think this past track record, while it is no indicator that future same things will happen, but past track record and the brand, right? For us, our brand is very important. ICICI Prudential brand is extremely important. Last 5 years, 3 years, 1 year, 7 years, our debt funds have given a very good experience to the customers. Look across the plethora of debt products that we have. Since we have not had a single default or a delay, the customer experience, he might have got a lower interest rate. And I'm very happy that you mentioned this basic point that do not chase YTMs or do not chase past returns. High return indicates higher credit risk also, right? It is very important that in a credit risk fund, please don't go after the person who has given you the highest return, because highest return also indicates the highest credit risk taken by that person. I'm not saying it's bad in taking credit risk. I am saying that balancing credit risk is extremely important. So please do not go by the track record of defaults that the company has, and do not go by the highest return. Chasing return in a debt fund is extremely dangerous. Look at an FD. Look at two companies which are giving out FDs. A company which is bigger and more stable normally gives a lower rate in FD than a company which has got the same thing. So we also invest in bonds. So companies which are more stable will always give a lesser rate, even within the same rating. I'll give you an example. 2 years back, HDFC, ILFS, and Diwan were all AAAs, right? But HDFC would give you a very lower interest rate because the credibility of that organization in the market, that organization was able to raise money even at a lower rate. So, and Diwan had to give a higher rate, ILFS had to give a higher rate. So if I have a bond manager who wants the highest yield because my customer wants an highest yield, then I can have the wrong incentive to go after that particular highest return. So you require a lot of controls and processes within the company where there is an independent risk department which does not allow you to chase the fund managers to go after the highest return provided by the AAA companies. All three were AAA, but the interest rate differential was as high as 1%. Right? So those are the nuances for which the average person can see the track record of this one. Look at the track record that we have over the last 5 years, 7 years, 10 years on our credit funds or on our debt funds, and that speaks for itself. And this is a very important time when markets, in the equity markets, are valued at a certain level. When we have got so much uncertainty in the market, in a deflationary environment, that is good. That products, it might sound very, very I think allocation towards that product is extremely important in this environment, right? And I'll be very happy that we are able to raise the confidence what in the last 2-3 days, which was law, towards the debt funds of every mutual fund in the country.
Okay, let's understand the worst case scenario. The worst case scenario, Nimish, in this case, what could be the worst case scenario for credit mutual funds? I'm not talking about your scheme, but I'm talking about generally this category.
See, every scheme is independent. It will be very difficult to give a thing on 45,000 crores because I would know. I'm not saying that there is anything contaminated anywhere. I'm just saying that I would know my scheme. So I'm just giving my scheme as an example to extrapolate to the larger thing. As long as you have got confidence on the portfolio, that particular portfolio of that credit risk fund, then government, I have seen 2008, I have seen 2013, then the whole system ensures that you get liquidity for that, right? So once the portfolio quality, the portfolio quality is extremely important in this case also. So as the government has shown just now, that it will support once, if there is a quality, I can go and raise money against it, or I can go and sell the portfolio if my quality is okay. I don't know whether I've answered your question.
Okay. I'm going to ask again basic questions, Nimish.
Yeah, please.
Thank you very much. No, I'm asking these basic questions because I want to first dispel the air of, of concerns which is there in the market.
Yes.
There are about 24 mutual funds in India. 4 or 5 mutual funds are run by very strong sponsors, HDFC, SBI, ICICI. So what happens in this case, this kind of a churn? Because when 2008 crisis happened, the big players got bigger. Do you see that happening? Do you see that money may move out of small schemes to large schemes in all categories now?
See, debt funds, if your processes have been right and you have not given credit losses to your investors, and that is shown by the past track record of not giving credit losses, the amount of upgrades and downgrades that you have had in your portfolio, and this is a litmus test for us, this period, that last 1.5 period when it was tight, we have got a lockdown and a very uncertain year ahead of us. If we are able to take through our portfolio in a smooth way in this kind of scenario, we had a review even 4 days back where we looked at our entire portfolio line by line. And we are pretty confident that we have done a good job for our investors, where investments have been made. And even if there is uncertainty in the market, NBFC, not a single investor of ours has come back to us asking for moratorium, that they need moratorium to pay whatever flexibility that SEBI has given us. Not a single investor of ours has come back. In fact, one of the sources of financing for us, people say, how will you raise money in such a short time? Right? Thursday, the incident happened. Friday, Monday, Tuesday, one of the good source of money is also the investments that we have made. A lot of our investors, we could go to them on Friday or go to them on Saturday and say that, why don't you prepay? You are supposed to pay in September. You are supposed to pay in July. Why don't you prepay? If there is redemption, we'll be able to use that money. So people have offered us prepayment also. So that is the kind of comfort you have with the quality of portfolio. Sorry for repeating the same thing again and again, but if you are in a money lending business or you are into debt business, right, you have to ensure that your money comes back. Everything else is jargon. So let us de-jargonize the whole thing. If I have given money to somebody, the money should come back. If that money is, there can be a mark-to-market loss. People get worried when there is an in-between there. Because if a particular, suppose one player in the industry gets desperate and he starts selling the papers at any rate, which happened in the last 2-3 weeks. When that was happening, if he sells a particular paper, which I also own, right? I also own, he also owns, he sells it at a higher rate, right? A 9% paper, he sells it at 10.5%. I also have to mark my portfolio at 10.5%. We are mark to market, right? So I also will have to mark the portfolio at 10.5%. So you might see temporary volatility. But eventually, if your 100 rupees comes back from the investors, that will come back in the fund. So that is the mark to market should happen, and that is the right way to manage bonds. Mark to market will happen, and that is healthy. If your value of the bonds in between goes up and goes down depending on the way corporate spreads move, or the interest rates in the country move, then it's very healthy. But eventually you will get the rate. If the guy pays back, if you have given him 100 and he pays back 100, then all the mark-to-market losses will be averaged out over a period of time. So come into this category of funds only if you have 3 years vision, that you will 3 years stay with the fund. Suddenly, something happens to one fund house, you should be confident that the portfolio that you have invested in is a good quality portfolio. The AMC has got a good track record and they have never had defaults. They'll manage money responsibly. They have the processes to manage money responsibly, and then only invest. Otherwise, don't invest. If you cannot invest, because the tax benefit of a debt mutual fund comes in this category comes only after 3 years. So if you don't have a 3-year vision, then don't come in this category. If you are going to get scared every time there is an incident somewhere outside, then you should not come into this category of funds.
All right, so appreciate your time. Glad you could join us, and stay safe and take care of yourself. Let's take a quick break. It's turning out to be a good day of trade, even though globally very little support is coming. I guess now markets are saying that Reserve Bank of India has given a credit line to mutual funds. That means government is cognizant of the economy, and hopefully more reforms are coming very soon.